Welcome to Talk Tickers. Today, we're digging into FinWise Bank's third quarter 2025 earnings. And let me tell you, this report didn't just meet expectations, it absolutely blew them out of the water. Let's get right into it.
And the market noticed right away. The day after the numbers dropped, the stock shot up almost 5% on some pretty big volume. So the question we're answering today is simple. What exactly did investors see that they liked so much?
All right, let's look at the headline numbers. FinWise posted earnings of 34 cents per share, which is a solid 13% beat. But the real showstopper here? The top line. Revenue hit $36.7 million. Wall Street was only looking for about $28 million. That's not just a beat, that's a massive 32% beat. Just incredible.
So, beating estimates is one thing, but how they did it is where the story really gets compelling. We're going to go inside the numbers to look at the key operational drivers that really powered this amazing quarter.
Now, this right here really caught my eye, the efficiency ratio. For a bank, you always want this number to be as low as possible, right? Well, look at this. It dropped from almost 60% in Q2 all the way down to under 48% in Q3 in a single quarter. That is textbook operational leverage. It just means they're getting way more bang for their buck, a super clear sign of disciplined spending.
And it wasn't just one thing. The whole machine was firing on all cylinders. Loan originations were a really robust $1.8 billion. Net interest margin, or NIM, expanded to a super impressive 9%. And their non-interest income, the fee revenue, hit $18.1 million. You add all that up and boom, total assets hit nearly $900 million for the very first time.
At the very heart of this growth strategy is something you've got to understand: credit-enhanced loans. Think of it like this. FinWise makes a loan, but their FinTech partners step in and guarantee it, backing it up with actual cash reserves. This structure is the whole key. It lets FinWise grow its balance sheet and its income streams with a whole lot less risk. It's a really smart model.
Okay, so that was the quarter that was, an absolute blockbuster. But now let's pivot, because the story is really about what's coming next. This strong quarter, it was just the opening act. The real growth drivers are just now coming online.
And here they are. On the left, you've got DreamFi. They're focused on financial products for underbanked communities, which is going to drive deposits and fee income for FinWise. Then on the right, you have Tallied Technologies. This is a big one. They're launching co-branded Mastercards for consumers and businesses. For FinWise, that means more of those awesome credit-enhanced loans and a ton of valuable interchange fees. And hey, don't just take my word for it. The CEO, Kent Landvatter, said it perfectly on the earnings call. This quote gets to the heart of their model. It's a one-to-many business. While these deals take time to set up, once they're done, each new partner can become a huge value driver, basically pouring fuel on the fire.
And this isn't some far-off dream either. This is happening right now. Look at this timeline. The Tallied credit card programs start launching next month. Then, December 1st, the deal closes, adding about $50 million in balances just like that. In the second half of next year, DreamFi is expected to start kicking in with meaningful income. And all of this is on top of management's guidance for $8 to $10 million in monthly organic growth. That is some serious momentum.
So, let's put it all together. A stellar quarter, that awesome operational leverage, and a really clear path to future growth. This brings us to our final take here at Talk Tickers, the next call. Based on everything we've just walked through, what is our official rating on the stock moving forward? Our rating on FinWise is outperform. The combination of strong execution and these tangible, near-term catalysts just makes a really compelling case for continued momentum.
So why are we so bullish? Our rationale for the outperform rating really boils down to four key things. First, the catalysts are tangible. Tallied and DreamFi are happening now. Second, the company has proven it can generate operating leverage. Just look at that efficiency ratio. Third, management is just executing flawlessly on their strategy. And finally, these strong results have reset what the market expects, creating a new, higher floor for the stock's valuation.
And here it is, our next call for Q4. We're modeling earnings per share somewhere between 35 and 37 cents, driven by that continued leverage and the first contributions from the Tallied deal. We expect credit-enhanced balances to hit around $115 million once that transaction closes. And the result? We anticipate continued positive price action as the market rewards this fantastic execution. This is not financial advice. All analysis is for informational purposes only.